Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Welcome back to the podcast. Thank you so much for being here. Thank you for tuning in for the first time. You guys, I love when you leave me reviews and 5 stars. 5 stars are my favorite. So if you want to leave them, please do. I appreciate it. Okay, today we are going to talk about premium financing and indexed universal life and why this is not a good idea. And for those of you, I am doing a possible video podcast today. So if you're watching on YouTube, you may see a video of this one. And I have my little shirt on that says 100% German, no sugar coating. So today, I'm going to try to be very nice and not be mean, but I might get a little bit mean. And so I recently had been notified of somebody saying, hey, I can do better than farming without the bank. Well, you can get a better rate of return and you can leverage your dollar 3 to 1. And it is so much better. And you farmers, don't follow Mary Jo. She's a dork. And so I want to address that because I have met with a couple potential clients who have also been told to do some premium financing and borrow against their land that is paid for, take that money and use it to pay premium. So in this whole process, it was basically said that, I've done this for 40 years. And ironically, Mary Jo has not done this for 40 years, so she's not as smart as I am. And so I thought today I would call in my colleague and really a mentor to me for the last 9 years for infinite banking, and that is Wade Borth. He also lives here in North Dakota, and he was a farm kid. So he really was the first person that understood why I wanted to help farmers and how that would be beneficial. Because a lot of people before that told me that I was an idiot. I can't help farmers. They don't have any money. Oh, on the contrary, we all have money, right? And so he has worked with me for 9 years. He was one of the first people to ever sit through any of Nelson's seminars. So he has also been studying infinite banking longer than I have. So welcome, Wade.
Well, thank you, Mary Jo. I have to say that you're not mean. You're just passionate.
It's German passion. See, all my listeners know this German passion thing. And I am dressed appropriately today. Not that anybody can see it if you're listening on your podcast app, but you sure know now.
Yep.
And you all know that the German passion comes out because I talk about it all the time.
You're protective and you're passionate.
Protective and passionate. I like that. That's good. So Wade has sold insurance for 30 plus years, and he really was kind of in this industry at the very forefront of universal life, variable life, and now indexed universal life. And so why me talk about it when I can bring in the expert and we can talk 30 to 30-year-old practicing, right? But the individual that has been targeting some of the Farming Without the Bank followers, listeners, clients, whatever, has said, oh, I've been doing it for 40 years, it works. And when I said that to Wade, Wade's response was?
I said, IUL hasn't been around for 40 years.
Right? So sometimes, I'm not perfect. We all know I'm not perfect. Since this is our 3rd recording of this podcast. Oh my gosh, you all, I forgot to put my headphones in the first time. And the second time I forgot to hit record. We just had like 55 minutes of the best podcast. And now we're on take number 3. So I'm not perfect. Nowhere near it. But when you are discrediting somebody, you should probably do a little bit of research first. So anyway, really the important thing here is that Wade has the experience. So Wade can tell us what his experiences have been with these universal chassis products? And what is the difference between a UL, a variable universal, and an indexed?
Yeah. All right. Well, thank you, Mary Jo. This is something I have a lot of passion around as well. And just if any of your listeners are car people, this is a good analogy. And somebody told me this one time, is that what universal life is that they want it to be a Corvette, but it's actually a Corvair. And if anybody understands what the Corvair was, it has a Corvair chassis and they just put a Corvette body on it. That's all they're trying to do. It's still a junk chassis.
They may not be driving Corvettes, but they do understand tractors.
Yeah. So this is not a John Deere chassis by any stretch of the imagination. But,
or a Case IH or a New Holland or whatever it is your favorite color is. We are not discriminatory against color.
But there are still junk chassis that are out there.
Yeah, there are.
No matter what paint you put on it, no matter what tin you put around it, if it's a junk chassis, it's a junk chassis. And that's really where we're at. Just as a real quick idea about how universal life works. So what happens is they take the insurance company back in the late 70s with Michael Milken and with E.F. Hutton, right? So Mary Jo's heard me say this before, and she's probably getting tired of it. But again,
third time is a charm.
But again,
I'm sorry.
E.F. Hutton was the company that when E.F. Hutton talks, people listen. And Michael Milken was the junk bond king of California. And so they thought, well, we're going to get together and we're going to, let you get a higher rate of return. And after, whatever that's been since 30, 40 years, whatever it's been, E.F. Hutton's no longer around and Michael Milken's in jail. And that's how universal life started. And so the whole thing is started around that. And what they were trying to do is they were trying to give the customer, because the customer wanted a higher rate of return, or they're chasing rates of return. How often have we heard that, Mary Jo? They're chasing rates of return. So they say, well, we're going to give you a higher rate of return, but we're going to transfer some of the risk to you for that policy. So all they did is they transfer the risk to the client. Now, they didn't come out and tell the client that, or maybe they even did, but nobody understands what that means. Nobody really understood what that really meant until the person's 20, 30 years into the policy. And now they go, this thing is going to crash and die, and it's going to lapse before I die. So I'm going to lose my death benefit and I'm going to lose my cash. Mm-hmm. And that's really what happened with those first ones, with the interest-sensitive universal life policies. So the interest-sensitive universal life policy says we can get you a higher interest rate. Well, that worked until it didn't, until the interest rates came from the 12, 13, 14% down to the 3 and 4%. And now the cost of insurance are eating these things up, and these policies are lapsing. And I'm servicing a book of business that just trying to help some clients out, some people out. I didn't sell these books of business, but I want to serve my industry. And so I'm out there trying to help these people understand you got to put more money in. You got to think about maybe lowering the death benefit, whatever it is, to keep these policies in force. Because at age 80, 81, 82, 83, this thing is going to lapse. And these people are in their late 60s, early 70s, late 70s, and they're lapsing because the interest rate wasn't what was promised. Mm-hmm. So that didn't work. So some genius goes, well, that was the old socialism. That was the old UL. Let's go to what's called VUL. Because VUL, which is variable universal life, says that we're going to tie this thing to the stock market, 100% to the stock market. Because with the stock market, we're going to get an average of 12% rate of return. So everybody takes their money, whatever they got, and they stuck it into these things. And the market fails. The market doesn't do 12%. And now, 20, 30 years later, these things are now lapsing or have lapsed a long time ago because the market just wasn't able to perform. And when that happens, the cost of insurance grows. And when the market doesn't perform, your cash value account goes backwards because the market didn't perform and it was eaten out by a cost of insurance. And so now it goes in this death spiral. So it takes so much energy and you have to have huge rates of return to get it out of that death spiral. So that didn't work. So the next genius comes along and says, hey, let's use what's called index universal life, which is kind of the worst of both worlds. We're going to do interest. We're going to credit an interest rate, but we're going to tie it to an index universal life. An index might be the S&P 500, the Dow, whatever it is. They have, the Russell 2000, Russell 5000. There's a lot of different indexes. And whatever that index is what we're going to credit you for the interest in your policy. Again, it's a gross rate of return, because it still has costs and fees to be taken from that. Well, at the end of the day, the gross rate of return means nothing because the insurance company is now controlling what those levers are, what they're being charged, what the fees are, what the mortality is. All those things are variable inside there, can change. And so the insurance company can change all those things.
And then on top of that, we add guaranteed universal life.
Oh, yeah.
Because all of these have been falling apart. So, except whole life, right? Where there are guarantees. So now we're going to add guaranteed universal life, which just says basically, hey, the universal didn't work, it fell apart. The variable didn't work, it fell apart. So now we're going to guarantee your death benefit, even though your cash value falls apart.
Yeah. Yeah. So I heard a gentleman say, and I love this one. He says, you know what GUL stands for? Guaranteed you lose.
That's awesome.
So the whole idea, and again, it's just these theoretical ideas, again, on the same crappy chassis, right? So they have the same awful chassis where they say, well, we're going to make this guaranteed. So you pay us this premium. In essence, it's termed to age 100, termed to age 121. Yep. And we're going to guarantee that you have a death benefit. You have no cash. You might have cash for the first 5 or 10 years maybe, but we're going to guarantee there's no cash, just death benefit. But if you miss a payment, if you were unable to make a payment, whatever the case might be, or you're late with a payment, in this 30 or 40 year period that you've had this policy, if you miss one payment, all those guarantees are gone. Mm-hmm. Is anything you've done, set up at a bank, even an automatic payment, always work for 30 years? There's a real problem with the guaranteed ULs. Mm-hmm. So again, the chassis itself, I think, is what's flawed, and everybody's trying to put a different coat of paint to make it look better. Mm-hmm. At the end of the day, there's just, we talk about guarantees. There's guarantees in the universal life products. You look at the illustrations, there's guarantees, but rarely do those ever go very far. Mm-hmm. And then the whole quiz is like, well, don't worry about it. The problem is, again, like I said, what they did, the insurance companies, because realize that with a mutual insurance company that I have a whole life policy with, I am an owner of that company. It's a mutual company. Well, now I'm a customer of the company when it comes to universal life products. And what they did, they said, well, we're going to unbundle this because you want a higher rate of return. We're going to give you that potential for a higher rate of return. But now they shifted the risk over to you as the consumer. And that's the whole problem, is that people don't understand what that risk is and how that has this long-term effect. They can see it in the short term, that it really doesn't make a whole lot of difference. But again, it's the long-term perspective that they're missing.
Mm-hmm. And so a universal may have some guarantees. A variable is going to have no guarantees. And an indexed UL, they are going to sell to you and say, oh, but you're guaranteed never to hit 0. Oh my gosh, I am doing you the biggest favor. We are never going to go below 0. But then in parentheses underneath, it says negative. That's a gross is 0. A net is a negative rate of return because we still had the fees, we still had the charges. So we're not guaranteed to make money, but we're supposedly not guaranteed to lose money. And I hear it over and over and over and over again. Every single time I have a client that has an indexed policy, well, I'm guaranteed never to lose.
Yeah. And the guarantees in those universal life products are guaranteed maximum charges. Now, if I look at my whole life policy, even on the guaranteed side, it goes up and to the right. It's always positive, always positive. Mm-hmm. There's not another product that can say that. Mm-hmm. Maybe if you're putting enough money into a UL policy, the guarantees might not go backwards, or it might go backwards. That's the whole point, is that there's nothing guaranteed there. It's just guaranteed what the maximum charges are going to be.
And so that is kind of the basis of what is happening inside Universal Variable Indexed. Now, when we talk about premium financing, there are companies out there, insurance agencies, not insurance companies, but insurance agencies out there, and people out there saying, well, you can go to the bank and you can borrow money from the bank and you can pay the premium of these policies. Well, when I go to the bank and borrow money, in one scenario here, is that this guy thinks he's so brilliant at 3-to-1. So I'm going to go to the bank and I'm going to borrow money, and I'm going to borrow money for 10 years to pay premium. When I do that, I set up a trust, and the trust owns the policy, and then the bank takes the policy as collateral. So now I don't have liquidity of that money. I don't control that money. And I have no guarantees because I'm in a product that's not guaranteed. The only guarantee here is that you're going to die and the bank will get its money if the policy survives that long. But the plan is you pay for 10 years and then at year 15, you borrow from the policy to pay the bank off, Wade, or you take the money from the policy to pay the bank off?
It looks like you take the money from the policy.
Okay. So then the policy may terminate. If you take all the cash value out and it doesn't continue to grow and you don't continue to pay premium, it could very easily terminate.
So that's why they reduced the death benefit at that time too.
Oh, they do a RPU, reduced. Yes. Okay.
Yep. Reduce the death benefit.
Okay. So now we are going to reduce the death benefit. So now you're going to die with less. Great plan. Keeps getting better every time we record this podcast. So, oh, y'all have to just understand. Like sometimes I should be blonde. So this whole strategy that Wade and I find very interesting is the fact that we are using a product that is not guaranteed. We are talking to farmers. I find this very interesting that these agents out there are targeting farmers to say, hey, if you've got some land that is paid for, use it to premium finance. We're going to do farming with the bank. Or we're going to borrow money, put it into a trust, and we're going to have a policy and we're going to farm with the bank again.
Yeah.
The whole point of farming without the bank is to make sure that we have liquidity so we can build our operation. We can buy equipment. We can expand or whatever it is we're going to do, right? Buy tractors, use it for inputs. That is what we're here farming without the bank. We are also here to talk about the fact that we need generational wealth and we need to stop buying farms every single generation. Well, so we're going to reduce death benefit. How is that going to help us for estate planning? It's not going to help us for estate planning. You know, Wade and I were talking about this a couple of days ago because let's be honest, I'm not going to lie to y'all. I didn't do the research on this. I sent Wade the link and he made the time to do the research on this because I didn't.
You know why, Mary Jo? I stuff like this just gets my German passion running as well. Because, you know, the problem I have is when we set false expectations and then we don't meet those as an industry, as society, individually, that drives me crazy. And that's my fear with this type of product, these type of things, these gimmicks, is that they're going to set false expectations and the clients don't realize it. They don't completely understand it until it's 10, 15, 20 years down the road. And they go, oh, I was sold a hill of crap. I mean, hill of beans. It's not working. Mm-hmm. Then they're going to paint the entire industry with this brush like, this is terrible. So I would rather spend time now. You know, I've been saying I'm in this industry for 33 years. I see myself in a midway point. I think I got another 33 years in me to do this. And I don't want to have to deal with this 30 years from now as well, because that's when people are going to run into this problem. It's like, yeah, that didn't work. And now I'm uninsurable. And now I got to come up with a tremendous amount of money to keep this thing going because expectations were false at the very beginning.
Well, and IUL started in 98, you said.
IULs, yep.
So IUL started in 98. They're 20 years new. Right. I have said for years that 401ks and IRAs are not traditional investments. I hate when people say that. Oh, this is a traditional investment. Traditional means long-term. Right. That's not traditional. They're 47 years old. We have a 20-year product of indexed UL that we are staking people's farms on. I mean, ultimately, the bank has that life insurance as collateral. The bank wants guarantees, right? They have your death benefit as a guarantee. They don't have your 401k as a guarantee. They don't have your IRA as a guarantee. If those are so awesome, why aren't we using them as collateral? Now, I can't take that as credit for that. Robert Kiyosaki said that in a podcast a couple weeks ago, and I was like, oh, that is exactly right. If IRAs and 401ks were so great, if rates of return, if your average rate of return was so awesome, then why isn't the bank wanting that as a guarantee? Now, in these indexed ULs, these people are talking about a 6.85% rate of return. Every single year, if you are going to do this strategy that they're talking about, they're basing it on a 6.85 rate of return. Now, in their video, I did watch some of it. in their video, I did not see them go any lower than 6.25. Did they ever hit below 6, Wade?
I can't recall that they did. But the point is that it doesn't really make any difference, whatever the rate of return. Because remember, it's a gross rate of return. And the insurance company can always adjust the levers. It's just like somebody says, I'm going to give you a 10 or 12% rate of return, Mary Jo, but oh, by the way, there's fees that are going to account for 6 or 7. Mm-hmm. Does it really matter what the rate of return is? It's what the net is at the end of the day.
Mm-hmm. And gross, that is something I'm going to touch on just a sec too. Gross rate of return is important because we have that same fight on the whole life side of things. When people say, oh, well, my dividend is 5%. We are much better than Mary Jo and Wade's company. My dividend's 5%. We are earning, and I heard this twice this week, we are earning an 8% rate of return in those policies. 8%, you know what? No, you're not using 8% gross, 8% net. It's 8% gross is what this company talks about. Oh, we are spectacular. 8% rate of return, gross, in a whole life policy. That same manipulation is used on the whole life side as what is happening on the indexed and the UL and the VUL as well. So we have to start asking as consumers, if somebody is trying to sell us something on a rate of return, is that an actual rate of return or is that an average rate of return?
Really goes back to the whole idea of why Nelson said, it's not about rate of return. You mentioned the first time we did this podcast, you mentioned, it was in the second paragraph of the introduction, right? This is instructional. This is not about rate of return, right? So this is not a get rich quick scheme. He talks about that in the first page.
This is not a sales technique.
Thank you.
For life insurance agents.
Yeah, it is just a teaching manual, how we need to think about money. So, because we're consumer mindset about internal rate of return, when in all reality, we're focusing on the wrong things. The people that kind of challenged you, they're focused on the wrong thing because they're not focused on what I call the external rate of return. What are you doing to grow your farm? What are you doing to grow your ranch? What are you doing to grow your business? Because that's your retirement income. That's what's going to provide you wealth. Not a rate of return inside of a policy. That's not going to magically make you, be wealthy or have this stream of income that you can't outlive. That's not the important part. The important part is what you're doing with the money while, and again, it goes back to being the and asset, what you're doing while the money still continue to grow and compound inside that policy.
And this strategy that this guy is using also focuses very much on retirement that you just mentioned. Yeah. And so we're going to focus very much on retirement. And then we're going to come in and talk to farmers about retirement. Well, I don't know. I've talked to thousands of farmers and very few of them talk about retiring. And so that is not their concern. And they will always tell you that their retirement is their land. Because if we can sell it to somebody else, even the kids while we're alive, why aren't we selling it? But instead, we're so busy over here chasing this rate of return in this IUL so that we can have the best retirement. Could we even have a better retirement? Let's just take us to Iowa as an example. If we had money inside of a policy that we could borrow against and we could buy land, right now in Iowa, we're at $13,000 to $15,000 an acre for farm ground. I don't know if you knew that, Wade, but it's crazy insane. And so if we can buy land in a position where it's going to increase in value, that is what Wade is talking about when he's talking about your external rate of return. That is what we were talking about when we call a whole life insurance policy your and asset, because you can put money into the policy and you can borrow against it and go buy land. What this person and what these other systems are doing is saying, hey, let's go borrow the money. And then if you're going to put it in a trust, you don't have access to it. So now we have to depend on that company to provide that 6.85 rate of return. So we have the money for retirement because it was an or asset. We had to put our money there or we had to buy the land.
Because again, they're focusing on the wrong thing. They're focusing on 15, 20 years down the road where you're going to say, I'm going to take this out for an income stream versus the mentality of people that have true wealth in this country of saying, let me buy an asset that can provide me a stream of income versus depending on an illustration that may or may not provide me that stream of income.
Because he's not focused on cash flow.
No, not at all.
These people in these other systems are not focused on cash flow. And cash flow is king. You need cash flow along with the infinite banking concept to do whatever it is that we want to do. But in this scenario, that's not happening. Instead, it's, let's get this better rate of return and let's leverage 3-to-1. And Mary Jo doesn't know what she's talking about. Well, Mary Jo does know what she's talking about because it's about farming without the bank. Yeah. It's about life without the bank. It is not about jumping in bed with the bank. Just like we don't need to be in bed with the government, we don't want to be in bed with the bank either.
You talked about leverage. That was one thing that was made, was like, use this leverage. And, quickly tell the story about Nelson, back in the early 80s, late 70s, early 80s. Mm-hmm. He was doing everything that he was, quote unquote, supposed to be doing, that all the financial gurus were telling him to do. Leverage yourself to the hilt, buy all this land. And then when interest rates went from whatever it was, 8 to 21%. What did that leave Nelson?
21 was prime.
Right.
It went from 8 to 23. The only reason these are fresh in my mind is because I looked at them yesterday. So 8 to 23%, $500,000 of his own debt, and then he carries $300,000 of a partner's debt that he couldn't pay.
Right.
And so Nelson was playing the game of investing and chasing these big returns
with leverage.
With leverage. Yep. With leverage. So if we're going to premium finance, what happens if we can't pay the bank back? Because the whole theory is we're going to pay the bank back in 15 years. What happens if that policy does not perform as illustrated and we don't have the money at 15 years? Yeah. Is the bank waiting at 15 years? Is that a hard loan that we have to have it paid off at 15 years? Are we going to go further and continue to pay? Because for 15 years, we're not paying any interest to the bank.
And again, it goes back to just that whole idea. Whenever you get in bed with the bank, who gets to be number one? Who's in the number one position? The bank. Who's in number two? The consumer, the farmer, the rancher, the business owner. They're always second. This is the exact opposite of what Nelson talks about. This truly is the exact opposite of what we teach. Is like, we want you to be in that first position. We want you to be responsible, honest banker. You got to do that. And then put yourself in the position to say, well, if I need a loan to expand my operation, to do something that maybe the bank isn't comfortable with. Think about how many times banks have said no to people trying to grow a great idea. All the time. It's because now you have put somebody else in the number one position that can nix your idea of how to grow your operation. Mm-hmm. So at the end of the day, when we look at it, we look at what Nelson was telling us. He experienced it. He's not just telling this from no experience. He experienced this. Mm-hmm. He had the banks tell him no. He had the banks knocking on his door. He had those sleepless nights because the bank was there in the very first position. Mm-hmm. And he says, I'm never going to have those snakes and dragons in my life again.
So when we look at infinite banking, the whole concept of what Nelson is saying is you get rid of the banks. Because if you do, you reduce the turning of money. You reduce the inflation. The Federal Reserve gets hurt. The government would be cut in half. A lot of people don't understand that theory behind IBC. That is the whole mission that Nelson had. But now what we do is we say, we're going to go to the bank and use a life insurance policy to leverage our dollar. Nelson says, if you are borrowing money from the bank, you are part of the problem. Yes, I am still part of the problem. I don't want to be a part of the problem forever, but I'm still part of the problem. The more money that we borrow from the bank, the more money that can get turned. So why do we continue to do that if it's not completely necessary? Just so that we can leverage money and still in one way, shape, or form be tied to the market, even if in an index where it's more reflective or the life insurance company gets to decide that, whatever. I don't want to be there. I don't want to be in the market. I want to have liquidity control and guarantees, and at the same time, be able to leave some sort of generational wealth.
You made a really interesting point when we talked the other day too, Mary Jo, because we were talking about this whole process of, we do premium financing, we put it into trust. Again, when you have to move that many shells around to make this thing work, it always makes me a little bit concerned. When I was growing up at the farm, my dad always said, stay away from the moving parts, right? What has the most moving parts on the farm? The combine, right? Mm-hmm. That's where everybody gets hurt. So anytime you add moving parts to anything you do, that's where you have uncertainty. That's where you can get hurt.
Mm-hmm.
You made the comment of, hey, these things might work if they didn't give up guarantees, if they didn't give up liquidity, and if they didn't give up the control. But you give up all those things to make these things happen. So then we have to ask the question, well, why are we doing it? Why are we even in this discussion with these people that are giving up all those things that are important to us to be able to take control of the banking function in our lives?
Mm-hmm. And you as a listener have to think about that question, because you are the one being out there bombarded with farming without the bank stuff, and now premium finance guys that are trying to make it even better. There is nothing free. Wade and I talk about this all the time. There is nothing free. Well, first of all, there's nothing free in life, but there is nothing free in the insurance industry. You are either going to get your money now or you are going to get your money later. Insurance companies have not been around for 200 years because they're idiots. They've been around for 200 years because they actuarially know how to plan better than the Federal Reserve, in fact. So we have got to pay attention, and you have to do your due diligence. If somebody says, oh, you can get this great rate of return and you can even do better than Mary Jo, you better take your rose-colored glasses off and go back to reality and say, what really is happening here, right? Are we just chasing commission? Are we really doing what's best for the client? Have they looked at everything? When people like this try to compare themselves to infinite banking, it's a complete failure every single time. And it comes down to three things: liquidity, control, and guarantees. It's really that simple. If y'all remember Nate, he said, it's easy when you quit making it so hard, right? So it's really three things: liquidity, control, and guarantees.
And there's a lot of people that want to put a lot of moving parts. They want to be the con man on the street corner with all the moving parts. They want to make it difficult because they want to be the gatekeeper and keep you confused.
Mm-hmm. And you all are chasing the quick buck. Well, let me ask, how long did it take to build your operation? Not overnight. So nothing is going to be fast. Nothing is going to be fast. And if you want the get-rich-quick scheme, you're asking for trouble yourself. You have to start paying attention and doing your due diligence. These guys are out there, like Wade said, moving their shells around, and you get to decide if you want to ask what's under the next shell to do your due diligence. But it is super frustrating to me when I see people go, oh, well, geez, I would love to hear. Like I had somebody said, I would love to hear what Mary Jo has to say about this strategy. Well, here I am telling you what I think about this strategy. I think it's absolute horse crap is what I think, because it is not something that is meant to get you away from the bank. It's farming with the bank. It's driving you to the bank instead of driving you away from the bank. And if these people would understand farmers, they would understand that we're leaving a legacy. We have generations that we want to pass these farms off to, and that's a conversation that would be had. You know, I met with two clients this week, Wade, that both of them were given a book by another agent. And this other agent is like, oh, you should, buy a life insurance policy because you can do this farming without the bank thing. And they don't want to get certified. And both clients read more information about infinite banking than the agent did. And I sit down in a meeting, an hour-and-a-half meeting, and I ask more questions about everything that's going on than anybody else ever asked them. One of these individuals was told that he's 55 and he's too old to have a whole life policy, and he wanted to do $40,000 of premium, right? The other one was like 25, and he was told to do $20,000 a year premium on himself, and he has a dad that's farming and a brother that's farming. Why is he doing another policy on himself? Why isn't he doing a policy on dad and his brother? 55 years old with $40,000 a year? That's a huge policy.
It goes back to, there's a lot of people out there that can buy the tools. You and I have something in common going on right now, is like we have renovations going on. And we see the difference between somebody that knows how to just nail a nail or a craftsman. The policies, the life insurance industry as a whole is just a tool. But somebody that knows what to do with it is way more valuable as a craftsman than just the tool itself. And that's the whole point. Is like there's a lot of people out there, they have the tool, so they think they're a carpenter. But in all reality, they're no better than any other wood butcher that doesn't know what the heck they're doing.
Wood butcher. Oh, I've not heard that term before.
You're the craftsman. You're the craftsman that knows how to use the tools that are available.
And we're certified for a reason.
Right.
We're certified so that we can carry on Nelson's legacy. We're certified so that we can teach people how to think differently. We are not certified to sell life insurance because anybody can sell life insurance. Well, not really anybody, because they're not even doing it right. I mean, when you're writing a paid up at 65 or a 20-pay policy on a 20-year-old, you don't know what you're doing. You don't know anything about the infinite banking concept. And so this is something that, Wade and I have really worked together for 9 years. We both believe the exact same thing. You do what's right for the client and it will all come back to you. It is about making sure that we are here to service our clients and we are here to teach. And that is something that within some of these forums that are online, people have commented about the fact that Mary Jo's customer service at her office is phenomenal. And I was actually happy to see that. My staff is phenomenal. We are here to teach. My clients have access to me anytime that they want access. I have specific days that I have blocked off just for clients. I have specific schedule links just for clients because it is a constant teaching if they so choose to do that. Those are things that are important to us because this was a 10-hour seminar. This book was a 10-hour seminar for Nelson. This is not something that is meant to be known right now. And Wade, how long have you been teaching infinite banking?
15 years.
Okay. I'm at 11.
Yeah.
So every day we eat, sleep, and breathe infinite banking. That's all we've done for that amount of time. And we still don't know everything.
And hopefully I don't get to the point where I know everything because I want to learn each and every day. I don't want to have the arrival syndrome.
Right.
And that's why being part of the Institute, having other practitioners out there, challenge their thought process. And that's why it's so important is because you do learn everything. If you wake up in the morning and say, what more can I learn today? You will learn something versus the arrival syndrome.
These other agents that are taking spins and saying, we're going to do premium financing, we're going to do indexed UL, we're going to do it with VUL. Nelson specifically said those aren't going to work, and he had never sold one of those policies. So when you take that and you combine it with the fact that why is there even an institute? For those very reasons. There never was an institute from the very beginning. Nelson trusted that people would do the right thing. But when people would come to him and he would teach them and then they would claim it as their own or they would spin it off into other products, he's like, no, you are not attaching my name to that. And that is exactly what's happening with farming without the bank. You have people like this that are like, I can do that. No, you can't because you're not doing it. Why not go get certified so you understand the thought process behind it? Because when I meet with people, what you went over with that client was how much money did you make a year? Put 10% in, we're golden. What? You didn't even ask them their expenses.
Again, it comes back to being the craftsman and not just having the tool.
It does.
I'll brag on you a little bit. You're one of the greatest craftsmen in our industry right now.
Why, thanks.
You're welcome. It's a compliment, but it's a true compliment. It truly.
See, even after 9 years, you still giving me compliments. It is. Wade's awesome. Okay. I think that covers it for the third time.
I've enjoyed it for 3 times.
Yeah. I'm not even going to call Wade if I hit stop and this thing doesn't record. I'm not calling him. We're going to wait for a better time. So I know that has helped a lot of you answer the questions about what is this premium financing? Should I be doing this? What's the difference between what these other people are trying to do versus infinite banking? And there's really nothing the same. And so I think that at that point, you can say what is the same would be a shorter list and it would be 0. The 2 words, this is what I told Wade the other day. There are 2 words that are the same: life insurance. Everything else is different. The type of life insurance they use, the reason they're doing it, nothing else is the same. If you want to farm without the bank, if you want to have a life without the bank, you are going to do that with the infinite banking concept. You are not going to do that by premium financing. and putting your business at stake or your livelihood at stake or whatever it may be. So I think this has been an awesome podcast. If you guys have questions, if you have concerns, you know where to find me, Mary Jo at Without the Bank. You can go to Farming Without the Bank. You can pick up any of my books, which are also on audio, and then you can get Nelson's book as well, and you can bundle those all together. I do encourage you, if you get the audio book, to also get the actual paperback book, because I am finding that people understand everything better when they can see the moving parts. But it has been fun, Wade. Thanks for being here.
Been fabulous. I've enjoyed every minute of it, all 3.
Oh, gosh, you guys. Thanks for putting up with us in this podcast.
Thank you.
Yeah, you're welcome. Okay, you have a absolutely fantastic week, and let me know if there's anything that I can do.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.